Okay, but everything happens for a good reason. I hope and I pray, I wish that all your other exams should be passed in the first attempt. Okay, now students, I welcome you all in my class. We are now about to start one of the very interesting subjects of ACCA. F7 financial reporting is a very interesting subject. Maybe I do not like reporting by myself, that is why I'm saying that. But what I have observed in all the students over the tenure of past 12 to 13 years, that the students like this subject very much, what I have seen. Now, F7, the name of F7 is financial reporting, and F7 is basically its older name of the subject. Now we do call it as FR. F7 is an older name of this subject. It's financial reporting. And financial reporting is an extension of financial accounting. We do know that the third exam of ACCA is financial accounting. FA, which we used to call as F3. The extension of F3, third exam of ACCA, is F7. So over here, we call it as financial reporting. Basically, financial accounting is financial reporting. Why? Because the purpose of making accounts is to publish the financial statements so that users of the financial statements can analyze them. When in the first lecture of F3, I was there, I told you the definition of financial accounting. What was that? It is an art of recording, classifying, and summarizing the accounting transactions. Please have a seat. Accounting is an art of recording, classifying, and summarizing business transactions for the purpose of analysis. And I told you at that time that please memorize this definition. The first part of the definition tells us that what do we do in accounting? What do we do in financial accounting? What do? We record, we classify, and we summarize the business transactions. In the second part of the definition, we learn that why are we doing all that work? Why are we recording the transactions, classifying them and summarizing them? For the purpose of analysis. How someone is going to analyze something? How is someone going to analyze something? Obviously, there must be few documents in front of us. We are going to read those. We are going to observe them. We are then going to analyze them. And then we are going to evaluate them and we can comment on them. Same happens in the case of the financial accounting also. The basic purpose of producing accounting records is that we need to produce the records so that users of the financial statements can get a help to analyze the financial position of the company. That is why now the name of the subject is financial reporting. We need to report our accounting records for the users of the financial statement. Although this is the 7th paper of ACCA, it is not a difficult one. It is not a complex one. It is very easy to pass as compared to the other subjects of ACCA, which are in applied skills module. F7 is one of the easiest papers to be passed. How can I say this? Because globally, the passing rate for F7 is higher as compared to the other exams. F5, the syllabus of F5, 5th paper of ACCA, is very lesser than F7, but still the passing rate for F5 is the least globally. Then we have F6, 6th paper of ACCA. It is one of the widest course in ACCA. It is having a diverse course. A lot of things are present in there, but still it is having a higher passing rate as compared to the F5. So that is why the reason to convince two people to enroll in F7 was this only one, that it is having a highest passing rate all over. Okay. Now, what are we overall going to study in this subject? The basic concepts are going to remain the same as we did study in our F3. We are going to read the same type of the things which you have already studied in F3. You are going to find them more or less the same one. But we are going to learn the things and we are going to understand them in a little bit more detail. Say, for example, in your F3, the final stage which you have learned was the preparation of the financial statements. Is it? How are we going to prepare the financial statements? You were being given a trial balance, and from that trial balance, you needed to prepare 4 important financial statements. Statement of changes in equity, statement of cash flows, statement of profit or loss and other comprehensive income, and statement of financial position. This was with what we have learned towards the end of the financial accounting. In financial reporting, we are going to start with that. We are going to revise making or the preparation of financial statements with the help of the trial balance, and then we are going to study the things in more detail. Over here, you have to learn about each and everything in very detail, because in the exam, you will not be having the same sort of questions as you have faced in your financial accounting F3 exam. The overall, what we can say, not the pattern, but the strategy of the examiner to check the students will be changed. You will be facing the constructed response questions. In the exam, you will be required to prepare your own financial statements. You will not be provided with the basic line items. In F3, you will be provided with the basic line items. You were required only to fill in the details. But over here, you must be knowing about all the line items which are presented in the financial statements. Same happens in the case of consolidation also. So whatever you are going to learn, you now have to memorize that as well. Together with that, in financial reporting, one of the important things which you are going to encounter is international financial reporting standards. We have discussed few important standards in F3 also, which were those IS 16 on the top, IS 38 we have discussed, IS 2 we have discussed, and a little bit more standards we have discussed in F3 as well. But here in F7, all of the reporting standards are going to be discussed. On the basis of this F7 exam, you can pass financial reporting diploma also, which you can get from the ACCA. Once you are going to learn this subject of F7, on the basis of this subject alone, you can get a good job in the market. Because once you are familiar with this subject, you can become a full-time accountant. Because all of the standards you are going to read, you are going to learn, and you will be able to prepare your financial statements, which is normally a job of an accountant in the organizations. So I hope that I have created a little interest in you people regarding F7. Now, students, let's have a look at the paper pattern. Our paper will be distributed into 3 sections. In section number A, we will be having objective test questions. Before to some time, we were calling these questions as short questions. These are the same. Short questions, objective test questions are the same ones. In this question, you are going to find true or false, any kind of fill in the blanks with the drop-down lists, or multiple choice questions. 15 objective test questions will be given to you, each carrying 2 marks. The total of this section will be 30 marks. Then we have section 2. In section 2, we will be facing objective case questions. These are the same as multiple task questions, MTQs, or we do call them as OT cases also. One scenario, a set of information, a piece of information will be given to you, and from that information, you have to do few questions. So you will be facing 3 objective case questions. Please come. Good afternoon.
F7.
F7. May I please know your name?
Summary.
Samri. Welcome to the class, dear. Please have a seat. Okay, so Samreen, we are discussing the paper pattern for F7. We are going to have 3 sections in our exam. In section number 1, you are going to face objective test questions. 15 objective test questions will be asked to you people, each carrying 2 marks. It is the same as you have found in F3 exam as well. You will be facing fill in the blanks with drop-down lists, true or false, or any kind of multiple choice questions can be asked to you people. Total of this section will be 30 marks. Then we have section B. In section B, we will be facing objective case questions. These are the same as multiple task question. One scenario, one detailed scenario, more elaborated scenario as you have faced in your F3 exam. It will be more elaborated one. You will be facing a scenario, and from that scenario, you have to collect some information, and then you have to respond to the given questions. Each of the multiple task question will be carrying 10 marks. Total of this section will be 30 marks, and then a new thing for you people, those students who have passed only first 3 papers of ACCA, this section is new for them. In this section, you are going to face constructed response question. 2 full-fledged questions, detailed questions will be asked to you, more or less. They can be in regards to the preparation of the financial statements for single entity or for consolidation. They can ask you to prepare cash flow statement. So like these elaborated questions will be asked to you in this section. There are few more questions which can be asked in this section. We are going to discuss them later. Anyhow, 2 constructed response questions will be asked to you, each carrying 20 marks. So the total of this section is 40 marks. So your total paper will be consisting of 100 marks, and as all of the papers of ACCA are, the passing percentage for this exam is also 50%. You have to gain 50% marks in order to clear that exam. One more thing in regards to this exam is that this exam, like all the other papers of ACCA, is also computer-based. You are not going to attempt this exam with the help of pen and paper. You have to attempt this exam on computer. How many of you did know this before? None of you? This is a computer-based exam. All of the ACCA exams are now computer-based. All of the exams, yes. At our times, it has been paper-based exams. There has been an option for paper-based exams, but now it's not there. So you should be familiar with computer as well. You should be knowing how to basically use the computer. You will be required to do the questions on the Excel spreadsheets or Word document. Only these 2 things you need to be familiar about, okay? So try to build on your practice as more as you can do the questions on the computer. Because some students do know all of the concept, but still they are not able to manage the time appropriately in the exam because they have not practiced so much on computer. Okay? Anyhow, I am assuring you, if you are going to follow the guidelines, if you are going to attend the classes, if you are going to do the revisions as I will be guiding you, there is no reason that you will not be passing your exams. Okay, just try to follow the guidelines and do revise the things. Revision kit, exam kit is the key to success. Try to finish the exam kit twice or thrice before to your exams. That is key to success. I have seen so many students who have passed their exams only by doing that exam kit. Even if you are not having a study text, you are studying from your exam kit alone, even then you can pass. And in the subjects like reporting, exam kit is very mandatory, it's necessary, it's crucial. You have to do that, okay? One more thing I want to tell you, then we can start our lecture also. So many students do think in ACCA that if it's a numerical subject, then no theory is going to be involved. It's not the case. Similarly, like all the other papers of ACCA, ACCA's policy is going to remain the same in this exam also. They will be having at least more than 40% of theory questions also in this exam. Hi, good afternoon. It's okay, it's fine. Please have a seat. So as I was telling you people that in this exam, similarly, like other exams of ACCA, we are going to have theory questions also. Almost 40% theory questions you can expect in this exam. Okay. Sorry, Marwa, we have finished few things. I will be explaining all these things to you later, okay? Don't you worry. Yes, my online students, are you cleared? If any one of you is having any kind of question or query, you are most welcome to ask. You can interrupt me during the lecture as well, I will not mind, okay? Yes, Ali, you do. Okay. Now, students, we have around 21 to 22 chapters of financial reporting which we have to cover. We are going to start with chapter number 1, which is basically going to have the revised topics of F3. What we have already discussed in F3 is slightly revised in this chapter. In this chapter, we are actually going to learn about the introduction. We are going to learn about the published accounts. Because in this chapter, we are just introducing the published accounts. Don't worry, I will be starting everything from the scratch. We are going to start learning from the basic definition of accounting. What is that? Accounting is an art of. Accounting is an art of. What is an accounting? It's an art of recording, classifying, very good, and summarizing. Which thing? Business transactions for the purpose of analysis. And the purpose for analyzing the financial statements are who? Stakeholders of the organization. The basic purpose of performing all of the financial reporting work is to provide the information to the stakeholders of the organization. Why are we doing financial accounting? To aid, to give help to the stakeholders of the organization so that they can get a know-how about the financial health of a business. How well a business is performing must be known by the stakeholders. Stakeholders are all those persons who are having any kind of interest in the business activities. Say, for example, government having an interest in the business activities, creditors, debtors, financial institutions, your customers, general public, charity organizations, all those persons who are having any kind of interest in the business activities just want to know about the business. And the basic way through which they can know about the business is financial statements, is the published accounts produced by the organization once in a year. For limited liability companies, it is mandatory by law to publish their accounts for the purpose of the analysis by the stakeholders. When we use the term recording, it means that we are discussing about the first phase of accounting. Recording phase is being done in which books? Books of prime entry. Recording phase is being done in books of prime entry. Whenever the transaction is happening in a chronological order, we have to record that transaction in our books of prime entry. There are 7 books of prime entry, as everyone already knows. 7 books of prime entry are sales daybook, purchases daybook, sales returns daybook, purchases returns daybook, cash book, petty cash book, and journal. Whenever the transaction is happening, whenever, I mean that whatever time it is in a day, night, evening, at whatever time it is happening, immediately we have to record it in the relevant book of prime entry. Once the stage of recording ends, the second stage of classification arises. When we are recording the transactions immediately at the time of their happening, obviously they are not classified. They are not grouped. We do not know that which all transactions are the same. In order to group the transactions, we have to classify them. The second stage of classification happens in ledgers. After preparation of the books of prime entry, the transactions travel to the ledger accounts. At the end of the day, all the transactions which have happened in a day have to be transferred to the ledger accounts. All the year, the ledger accounts are going to be taking the transactions from the books of prime entry. When the year ends, those ledger accounts have to be closed. What is the meaning of closing the ledger accounts? We do balance our ledger accounts. We do close them and we do see that how much balance is present in those ledger accounts now. After closing the ledger accounts, the third stage and the final stage of accounting starts, that is the summarizing stage. Summarizing means that we have to prepare the financial statements of the organization. The books of accounts in which the summarizing of the transactions is being done are known as financial statements. It is where we need to go while we are learning financial reporting. After ledger accounts, when we are going to close them, the balances does travel to the financial statements. There are 4 financial statements which limited liability companies have to prepare. What are those financial statements? Statement of profit or loss and other comprehensive income. The older name for this statement has been income statement. It's on us whether we want to call this statement as an income statement or statement of profit or loss and other comprehensive income. IAS 1 does not have any problem in this regard. Both the names are being used by the organizations outside, around ourselves. Then the second important financial statement is statement of financial position. The other name for statement of financial position is balance sheet. Third important financial statement which has to be prepared by the limited liability companies is statement of changes in equity. And the last important financial statement is statement of cash flows. Apart from this financial statement, all the other financial statements are going to be made up following accrual basis of accounting. When you are the student of financial accounting, you must be knowing the difference between cash basis of accounting and accrual basis of accounting. Whatever transactions you have to record in your books of accounts must be recorded on the basis of accruals. Accrual basis of accounting means that whenever income is generated, it has to be recorded, whether received in the form of cash or not. On the other hand, whenever the expense have been incurred, they have to be recorded, whether paid in the form of cash or not. All the books of accounts, all the financial statements, statement of profit or loss, statement of financial position, statement of changes in equity, are going to be prepared following accrual basis of accounting. Only one financial statement, statement of cash flows, does not follow accruals basis of accounting, but it follows cash basis of accounting. Which means that whenever actually cash is going to inflow to the organization or cash will be outflow to the organization, that we are going to record in our statement of cash flows. Otherwise, we are not going to write. So these are our financial statements. Together with that, one important thing which you have to prepare and you have to publish together with these financial statements is notes to the financial statements, which are also known as disclosure notes. And disclosure notes are for exceptional items. Exceptional items is used as a jargon in financial reporting. Exceptional items is the term which is given to the material items in financial reporting. All those material items which are already presented in the financial statements, but they need more elaboration, will be written in the disclosure notes as well. We are going to write about the amount of those material items together with the calculations which we have performed in order to calculate those material items. So all these 5 things become a part of our annual report, which we ultimately publish, and users of the financial statements like you and myself do get a know-how about the organizations by having a look at those financial statements. If you want to see any of the financial statements of any of the organization, you can just go to the Google and you can search about that. Just go to the Google and just look for the financial statements of Nestle, say for example. There will be published financial statements of Nestle for every year. Now, students, let's start our chapter number 1. Yeah, please erase it. Yes, Hamza, are you cleared?
Yes, miss.
Okay, great. Look, now the overview of this chapter is telling you about the basic financial statements, which are being prepared by the limited liability entities. So they have given us the name company financial statements, statement of financial position, statement of changes in equity, statement of profit or loss, or the other name for it is statement of profit or loss and other comprehensive income. They have skipped the 4th important financial statement, that is statement of cash flows, because in the other full-fledged chapter, they are going to discuss statement of cash flows. Anyhow, you should be keeping this thing in your mind. Sometimes in the multiple choice question, they will be asking you, how many financial statements are there which the limited liability companies have to prepare? These are 4, including statement of cash flows as well. In this chapter, we are going to learn about we are going to learn about the not-for-profit public sector entities as well. Little bit discussion is there. Anyhow, this chapter is just a revision of the previously taught topics in our F3. Now, students, there is a standard, International Accounting Standard number 1, which deals with the presentation of the financial statements. Long back, you have studied already that no standards tell us or require us to follow the formats, any kind of the formats for financial reporting. Organizations can present their financial statements as per their own wish. But IS1 presentation of the financial statements gives us the minimum 9 items which must be presented in our financial statements. We can prepare our financial statements in any manner, but in order to promote comparability, IS1 tells us about the minimum 9 items which must be presented in our financial statements. IS1 presentation of the financial statements tells us that the complete set of the financial statement comprises of statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flows, and accounting policies and explanatory notes. As per IS1, the complete book of accounts, the complete set of the published accounts will be including these 5 things. The last one is disclosure notes, in which we are going to write the accounting policies of the organization, and all the exceptional items are also going to be mentioned. As they have written over here about the exceptional items as well. When you are preparing your 4 financial statements, the story doesn't end over there. You have to provide and disclose a proper information regarding the exceptional items. Exceptional items are all the material items. And what are material items? All those items which are having the capacity to influence the economic decisions of the users of the financial statement. Exceptional items are all those items which, if skipped from the financial statement, will be affecting the decisions of the users reimbursement. When we are not going to write these material items in our books of accounts, the decisions of the users are going to be affected in a bad manner. That is why, together with the preparation of the 4 financial statements, it is mandatory to prepare a set of the disclosure notes in which we are going to write accounting policies of the organization. All those information, set of information which is already presented in the financial statements but need extra information, and all that information also which is not presented in the financial statement but it is mandatory for the deeper analysis of the financial statements. So this is exceptional items. Now students, as in this exam, you will be required to prepare the financial statements by your own. So unlike F3, you should be learning the formats of the financial statements as well. In this subject, you need to learn the formats of all the financial statements. You should be learning about the basic and minimum line items, which must be presented in each of the financial statements. Got it? So from your book, I have taken few notes. Please have a look at these. These are from your book. Please get it in the next one. Please share it with Aisha. We have this. Here. Okay, my online students, I have sent you the soft copy of the book in the group. I have shared it. The soft copy of the book is shared in the group. Is it? Please go to page number 4.
Which group, miss?
Your class group. Hamza, are not you added to that group?
No, miss.
I'm sending the book to you as well. Okay. Send Hamza. Okay, please access page number 4. First, we are going to see that which line items must have to be presented in each of the financial statements. And I request you people to learn all these line items. Okay. First, you can see the statement of the financial position on page number 4. Is everyone able to see that? Whenever you have to prepare the statement of the financial position, you have to give a heading like this. On the top, you have to mention the name of the company. In the second line, you can mention the name of the financial statement which you are preparing. In the third line, on the same line, you have to present the year-ending date as well. Organizations have to prepare their financial statements on the basis of their reporting period. Reporting period is an accounting period for which the organizations are preparing their accounts. It's usually 1 year. Okay. So the name of the financial position, as you can see, it's written statement of financial position as at 31st December 2008. Please also note that statement of financial position is a snapshot of 1 day. That is an ending day of the reporting period of an organization. It tells us that on the last date of the reporting period, what is the position of an organization? It is not a running statement. It is not giving us an overview in a running way for all over the year. It is telling us that what the organization is having at the last stage of the reporting. Okay. Statement of financial position will be including 3 elements of the financial accounting: assets, liabilities, and equity. Statement of financial position is based upon the accounting equation. Statement of financial position is based upon the accounting equation. What is an accounting equation? Assets is equal to liabilities plus equity. We do prepare the statement of financial position on the basis of this accounting equation, which tells us that at any time during the year, the total assets of the company must be equal to the sum of its liabilities and equity. Because assets are the resources of the business. Resources are all those things with the help of which a business is earning its revenue. Assets are resources of the business, but these resources have to be bought by the business through some source. So the sources through which the business finances its assets are liabilities and equity. Business has to be started with the help of the assets. If business is not having economic resources to start to go on, how is it going to go on? It is never going to be started, it is not going to flourish. So assets are the resources, but in order to buy those resources, we should have to get some finance or other resources or other sources as well. So the sources through which we are getting the finance in order to get these resources are liabilities and equity. Liabilities are the rights of the third parties on the company. Whatever rights of the third parties on the organization are known as liabilities. In simple language, we do say all the obligations of the business are its liabilities. Whatever responsibility a business is having, it is known as a liability. But in the eye of financial reporting, we say the right of the third parties, apart from the shareholders, is known as a liability. Whatever right the third parties are having on the business is known as a liability. On the other hand, we have equity also. What is equity? The right of the shareholders on the organization. That is why we also say that assets minus liabilities is equal to equity, which means that after fulfilling all the obligations, all the liabilities, whatever is remaining in the business belongs to the equity shareholders. Whenever we are fulfilling all the liabilities, after fulfilling those responsibilities, whatever is remaining in the business belongs to the equity providers. Anyhow, your statement of financial position is based upon this accounting equation. And what is an accounting equation? I have tried to elaborate briefly in front of you. Now, students, let's have a look at the line items which you have to present in your statement of financial position. We are starting with the assets. What are assets? All the resources which the business is using in order to earn income. Okay. Assets are broadly classified into two types: non-current assets and current assets. What are non-current assets? All those assets which will be helping the business to generate the revenue for the period of more than 1 year. Non-current assets. Under non-current assets, we have further two categories. Which two categories? Tangible non-current assets and intangible non-current assets. What are tangible non-current assets? Those assets with the physical substance are known as tangible assets. Intangible assets, all those assets without physical substance are known as intangible assets. Got it? So whether non-current assets or current assets, they have to be reported under this head. So under assets, you can see we have non-current assets first. Property, plant and equipment, IS 16. Investments, if it's investment property, IS 40. These are the standards related to the non-current assets, tangible non-current assets. Intangibles, we already know it's IS 38. So below two tangible non-current assets, we can mention intangible non-current assets as well. Then we have current assets. Inventories, we have trade receivables, cash and cash equivalents, assets held for sale. We are going to get total assets. Then we have equity and liabilities. Under equity, we should have to mention share capital and all the reserves of the organization. Under share capital, obviously, we need to write which sort of capital? Nominal capital. Okay. Issued share capital. This is issued share capital which we have to write. Then we have retained earnings. We have already discussed in F3. There is some knowledge which you have to bring forward as well. Closing retained earnings are written over here. The formula to calculate the equation to calculate closing retained earnings in LLC is opening retained earnings plus profit for the year. If it's loss, we have to deduct, then minus dividends. And if any capital is being introduced during the year, you also have to add that. So you will be getting closing retained earnings. And we have other components of equity, which can include revaluation surplus, share premium, etc. So it will be making the total equity portion. Then we have non-current liabilities. All those liabilities which have to be fulfilled after the period of 1 year are known as non-current liabilities. So if there are long-term borrowings, deferred tax, which we are going to learn in IS 12, we have full standard on tax as well. So deferred tax will be written over here. Then we have current liabilities, trade and other payables, short-term borrowings, current tax payable, and short-term provisions. Current liabilities are all those liabilities which we have to fulfill within 1 year. Okay, so it will be giving us total equity and liabilities. Total equity and liabilities must be equal to the total assets of the organization. Okay. Is anyone having any confusion regarding this? Now, please try to memorize all the line items, because in the exam, you will be required to prepare your own financial statements. Okay, now please have a look at the statement of changes in equity. It's a second important financial statement prepared by the limited liability company. Statement of changes in equity, as its name is telling you, statement of changes in equity. It will be telling you all the changes which are going to happen in the equity of the organization during the year. Whatever changes are going to happen in the rights of the equity holders during the year have to be mentioned in this statement of changes in equity. And the balances, the ending balances, closing balances of the statement of changes in equity does go to the statement of financial position also under the head of equity. So what do we normally mention in statement of changes in equity? Whatever we do mention under the head of equity in SOFP. Share capital and all of the reserves. So namely ordinary share capital, then we have share premium if any. If there is a net profit, it is also going to be mentioned. Retained earnings, we have any kind of dividends. So statement of changes in equity is going to include that. Dividends paid by the organization just come only in one financial statement, that is statement of changes in equity. Dividends are not reported in any of the other financial statements. Anyhow, let's have a look at the format. On the top, as usual, we are going to write the name of the company. In the second line, you can write the name of the financial statement as statement of changes in equity. In the third line or in the same line, you can write the reporting date as well. You can see that it's for the year ended 31st December 2008. If 31st December 2008 is the closing date, opening date is 1st January 2008. 1 day and 1 month after. Okay, that is the opening date of the reporting period. Now over here, they are mentioning share capital, share premium, revaluation surplus, retained earnings. Horizontally also, you are going to find the column of total, and vertically also, you are going to find the column of total. Okay. Then you can find balance at 31st December 2007. You are going to start with the opening balances on all these items. What has been the opening balance for share capital, share premium, revaluation surplus, and retained earnings? You are going to start with that. Then during the year, what has been the movement in these balances? You are going to note that. Say, for example, prior year adjustment under IS 8, see chapter 8. We are going to go to that as well. Okay. Then we have restated balance. And then we have dividends. Dividends are going to be deducted from the retained earnings. If any capital is being issued during the year, you have to add that. If that capital is being issued at a premium, then it also has to be added in the column of share premium. What is the meaning of issuance of shares at premium? When we are issuing the shares at a price more than their face value, the extra amount over and above the face value is known as a share premium. After that, total comprehensive income, transfer to retained earnings, revaluation surplus, if any, is transferred to the retained earnings. We are going to deduct from the revaluation surplus and we are going to add to the retained earnings, and we are going to get the closing balances, which we are going to mention in our statement of financial position as it is. Okay. Third important statement, statement of profit or loss and other comprehensive income on the next pages. Now, IS 1 gives us the liberty in the preparation of statement of profit or loss and other comprehensive income. IS 1 says that we can make one statement in regards to the statement of profit or loss and other comprehensive income. Or we can make two separate statements, one as statement of profit or loss and the other as other comprehensive income. You must keep in mind that in statement of profit or loss, all those incomes and expenses are going to be written which are realized during the year, which have been realized or materialized during the year. In the other comprehensive income, we do write those items, those incomes or expenses, those gains, those losses, which are not yet realized. And the major example of this is revaluation, revaluation surplus. When the property under IS 16 is revalued upwards, we do write this revaluation surplus on the one side in the statement of financial position, on the other side it goes to the statement of other comprehensive income, because that gain on revaluation will be realized only when the asset is going to be sold. Unless the asset is being sold, that profit is not going to be realized. So since it is unrealized, that is why we are going to write it in other comprehensive income. So just keep this short thing in your mind, that all the unrealized incomes and expenses will be going to the other comprehensive income, whereas incomes and expenses realized during the year will be written in the statement of profit or loss. Let's have a look at the basic format. On the top, we can write the name of the company, then statement of profit or loss and other comprehensive income for the year ended 31st December 2008. First, we write revenue, that is about sales revenue. Credit sales and cash sales both have to be mentioned over here, including sales tax. Do we write revenue including sales tax? Who says including sales tax? Who says excluding sales tax? Excluding sales tax? Yes, you are right. We do write revenue excluding sales tax because sales tax is not our revenue. Is sales tax our revenue? It is not going to go finally in our pockets. We have to pay it to the government. So revenue excluding sales tax is going to be written. If there are any return inwards, we are going to deduct those also. Okay. Then we have cost of sales. Cost of sales is calculated as opening inventory plus purchases minus any kind of return outwards plus direct costs minus closing inventory. This is cost of sales. When we do deduct cost of sales from revenue, we do get gross profit. Hamza, Angelica, Samiha, are you getting clear? Afaq?
Yes, miss.
Okay, great. Okay, well, once we are going to calculate the gross profit, then the turn of distribution and administrative expenses does come. Distribution and administrative expenses are indirect costs. As a rule of thumb, you can keep in your mind that all those expenses that you are doing on the purchases are coming before to the gross profit as the direct cost. All those expenses which you are doing on the sales will be coming as the indirect expenses on the after the gross profit. Okay. So distribution costs, administrative expenses, including your salaries, your commissions, your any kind of depreciation, these can come over here. You will get the figure of profit from operations. Profit from operations is also known as operating profit. Profit before interest and tax, PBIT. We do get profit from operations. Then we do deduct finance cost, and if we do have any investment income or other income, we are going to add it. The figure which you are going to get is profit before tax. After deducting income tax expense, we do get the figure of profit for the year. This figure of the profit for the year is the one which has to be added to your opening retained earnings. This one, profit for the year. Okay. Then we have other comprehensive income, in which we can write all the unrealized gains or losses. Gain or loss on revaluation, IAS 16. Gain or loss on fair value through other comprehensive income, financial assets, IFRS 9, which is one of the standards from which the students do run away. Anyhow, the gain or loss on fair values through other comprehensive income from financial assets, IFRS 9 is also going to be added over here, and we will be getting the total figure of the total comprehensive income for the year. Anyhow, this total comprehensive income for the year is not the figure which you have to add in the opening retained earnings. You are going to add profit for the year in your retained earnings. Now, this is the first form of the format which you can follow in the statement of profit or loss and other comprehensive income as per IAS 1. You can present statement of profit or loss and other comprehensive income separately also. And you can find the alternative presentation in the next page as well. You can analyze that the basics are remaining the same, but they have just divided the statement into two parts. The first part is a statement of profit or loss, and the second part, which they have presented separately, statement of other comprehensive income. Otherwise, all the line items are the same. So we are not going to discuss it again. You can see that first they have made XYZ statement of profit or loss for the period ended 31st December 2008 with a similar items. And then they have made XYZ statement of other comprehensive income separately. Otherwise, the line items are the same. Now, fourth important financial statement is which one? Statement of cash flows. For that particular statement, they have not provided the format here in this chapter. Okay, because they have full-fledged chapter for statement of cash flows. In most of the books regarding financial accounting, it is discussed separately. Got it? Now, students, we are going to start by preparation of the financial statements now. We have ended our F3 on the preparation of the financial statements, and we are going to start our F7 by the same topic. So here is example number 1 given in front of us. Students, online students, it's at page number 9, example number 1.
Okay, Miss.
As usual, we are going to read the requirement of the question first. On the next page, students, there is a requirement written. Can everyone see that? Prepare Piccolet statement of profit or loss for the year to 31st March 2009 and the statement of financial position as at that date. You are required to prepare the Piccolet statement of profit or loss for the year to 31st March 2009 and the statement of financial position as at that date. Soon after looking the requirement in the exam question, you will start preparing your statements in the exam. So one by one, we are going to prepare these financial statements, students, statement of profit or loss and other comprehensive income and statement of changes in, statement of financial position. Will I switch on the lights or is fine for you? Switch on the lights. Okay, example number 1, published accounts. What we have to do, we have to prepare the statement of profit or loss. On the top, we are going to give the heading. What is that? The name of the company is Piccolet. And then we are going to write the name of the statement. Statement of profit or loss and other comprehensive income for the year ended 31st March 2009. Students, similar to this question, you will be facing a trial balance in the exam. And from that trial balance, you then have to prepare your financial statements also. Okay. So as you can see, they are giving you the trial balance to say the following information has been extracted from the books of Picolet for the year to 31st March 2009. Here is the trial balance and different items are presented in the trial balance. What happens in the organization while making the accounting records? They do prepare books of prime entry. After that, ledger accounts. Before the preparation of the financial statements, they do make trial balance. Trial balance is not the part of the double entry system. It is being prepared only to finalize that whether we are good to go for financial statements or not. When the debits and credits of the trial balance does match, it does not always mean that there are no mistakes in our accounts. There can be some mistakes which can be caught by the trial balance, and there are some mistakes which cannot be caught by the trial balance as well. Anyhow, before the preparation of the financial statements, just for the satisfaction of the bookkeepers, they do make the trial balance to see whether all the debits are equal to the credits. Otherwise, it means that there are mistakes in the previous accounts and we have to correct those before the preparation of the financial statements. Now, students, two statements we are required to prepare: statement of profit or loss and other comprehensive income. And together with that, we are required to prepare statement of financial position as well. Statement of financial position as at 31st March 2009. I am preparing both the statements at the same time so that after having a look at the trial balance, those items which have to come in the SOPL, I will write over there. Those which have to come in the statement of financial position, I will write those over here. Got it? Before the preparation of the statement of profit or loss, students, you must prepare the basic format. Sales. From sales, if there are any returns, you do deduct them. Am I right? After that, you do deduct cost of sales. Cost of sales is made up of opening inventory, add purchases. If there are any purchases returns, these are going to be deducted. All the direct costs like wages are going to be added over here. Then we do need to deduct closing inventory. After deducting cost of sales from the sales figure, what do we get? We get gross profit. After getting gross profit, we do deduct administrative expenses, and we do deduct which expenses? Distribution expenses. The figure which we do get after deducting these two figures is known as profit from operations or profit before interest and tax. From this figure, we do deduct finance cost, or if there is any other income like investment income or dividend income, we do add it. The figure which we do get is profit before tax. From this figure, then we do deduct the tax expense for the year, and we do get profit after tax. This is the profit or loss for the year. So before doing any calculation in the exam, please make sure that you are preparing the format like this. Okay. Similar you can do in the case of the statement of financial position as well. You do write assets first. Under assets, first you write non-current assets. Then you write current assets. Then we have equity. Is it? After equity, we have non-current liabilities. And in the end, we have current liabilities. When you prepare this basic format, then it becomes easy for you to do the examination question. Now, the question in the exam will not be a simple one. They will be trying to test all of the reporting standards from you people with the help of this question. All of these standards, if you are clear about those standards, then only you will be able to prepare these financial statements. Because we are just in our first lecture, that is why we are starting with the very easy question, which is not including a lot of standards in it. But in the exam question which will be coming in front of you will be including almost, not all of these standards, but at least 7 to 8 standards will be tested over there. And that choice is, examiner's choice has to be there. But I'm telling you, IS 16 is always going, it does always come. IS 38 always come. Nowadays, IFRS 9 is very popular one. IS 38. So these standards are the favorite standards of the examiner. Anyhow, now let's have a look at the trial balance. My online students, you too have a look at the question now. The first thing is administrative expenses. Administrative expenses are written where? In the statement of profit or loss. Administrative expenses. Students, my presentation will be very awful. I'm sorry for that, okay? Administrative expenses. Once you are done with that, you can just mark a tick with administrative expenses. In the exam also, you are going to follow the same strategy. It means that you are not going to come back to this item, okay? You have already finished it. Interest paid. Interest paid 5. Where are you going to write that? Statement of profit or loss in finance cost. This is your finance cost. 5. The values are in thousands. Students, the items which are in trial balance have only one adjustment. The items which are in trial balance do have only one adjustment. The items which are in additional information will be having 2 adjustments. Okay. So interest paid we have written, then called up share capital. Ordinary shares of $1 each. Ordinary share capital just go to statement of changes in equity. So we are going to write ordinary share capital. How much it is? 200. Those which we are finishing, you can make a tick regarding those. Then we have dividend. Where does dividend go? Dividend. If it's dividend received, it can come in our statement of profit or loss. If it's dividend paid, it can go only in the statement of changes in equity. Dividend paid never ever comes in any of the other financial statement. It goes only in the statement of changes in equity. Moreover, when you are going to calculate the closing retained earnings in your statement of profit, in your statement of financial position, over there also retained earnings have to be deducted. Okay? Because in this portion, the figures which you are writing are actually coming from the statement of changes in equity. The closing balances of the statement of changes in equity are basically reported over here. So that is why dividend paid is going to be deducted from the retained earnings in your SOFP, and on the other hand, it will go only in the statement of changes in equity, no other place. Okay, so dividends, when we are going to write the retained earnings over here, because we are not required to prepare our statement of changes in equity, so we have to make a treatment over here. So when we are going to calculate our retained earnings, from those we are going to deduct 100. Is it 100? No, sorry, dividend is 6,000. So we are going to deduct that dividend from here. Students, in order to calculate retained earnings, what is the equation? Do I need to revise? Opening retained earnings plus profit. If it's loss, it has to be deducted. If we have dividends, those have to be deducted. If any of the capital is introduced during the year, we have to add it. So like this, we are going to get the figure of the closing retained earnings. I think we should switch on the light. Is it better? Better? Okay. Okay, then we have, we are done with dividends. You can mark a tick with them as well. Then we have cash at bank and in hand. Cash at bank and cash in hand is what, Ali? It is a current asset. So where do we write current asset? In our current assets, here. Cash at bank, it is 9,000. Okay, then we have income tax, remaining balance from the previous year. Who is going to tell me that where are we going to write this income tax? And what is this basically? At least my older students should be telling me this. The income tax figure, which is written in the trial balance, is the provision for income tax. It's a provision for the income tax. It is not an estimated tax for the year. Estimated tax for the year does come in the additional information only. So the tax which is mentioned in the trial balance is a provision for the income tax. If its balance is written on the debit side, it's an under provision. If the balance is written on the credit side, it's a over provision. Students, please make notes of it. In the end, I will not be going to the examination hall with you. Okay? So you need to do the exams in tough conditions. So please write the notes. The provision, the income tax which is written in the trial balance is a provision. If it's written on the debit side of the trial balance, it's under provision. If it's written on the credit side, it's over provision. Now, what is the treatment of the under provision? And what is under provision? We are going to discuss it in IS 12 in detail. But under provision is a type of a provision, or when we have provided for the tax lesser, the actual tax is more, but the tax provided is lesser. It is known as an under provision. Got it? If it's an under provision, we have to add it to our current year estimated tax. Under provision, we are going to add. How much under provision of tax is there? 10. In this tax expense for the year, this under provision is going to add. It means that under provision of the tax increases our expense. Okay? There is no other treatment for the under provision of the income tax. Take that and we are done with that. Now, warranty provision. Warranty provision of 90,000 is there. Students, we are going to do it. We are going to do the same treatment for it as we do for the provisions normally. Increase in provision, decrease in provision. Do you remember? Increase in provision does increase our expense. If there is a decrease in provision, it reduces our expense. So we are going to come back to it later. Let's move to the other one. Just make a staring on it. Then we have distribution costs. Distribution cost of 240. Where do we write these? In statement of profit or loss. Here are distribution expenses. How much are these? 240. Then students, we have land and buildings. Land and buildings at cost, they have differentiated among land and buildings. And the total of the land and buildings is 210,000. Accumulated depreciation on land and buildings is 48,000. Ali, how do we calculate the depreciation on land? Okay, any one of you can tell me how can we calculate the depreciation on land? Very good, excellent. Land never depreciates. Very good, Sharifa. Land never depreciates, it always appreciates. That is why they have differentiated among the values of land and buildings. Land they are separately mentioning and buildings are being mentioned separately. So opening accumulated depreciation is being written. What is an accumulated depreciation? The total sum of the depreciations taken on the asset over the useful life up to the date. Okay, then plant and machinery cost is being given. And its accumulated depreciation is also given. We do not write them in our statement of profit or loss. We do take them to our SOPL. Land and buildings, we are going to write in our non-current assets. land and buildings. Out of this, land is how much? 110,000, whereas buildings are 100,000. And we need to deduct accumulated depreciation also from here. How much it is? 48,000. Okay, because we are writing in thousands, that is why we are only going to write 148, and the value of the land is 110. Got it? Then we have plant and machinery. Plant and machinery is also going to be written in non-current assets. Plant and machinery is how much? It's 125,000 minus accumulated depreciation of 75,000. Okay. Then we have retained earnings. Look, opening retained earnings they have given. Opening retained earnings on 1st April 2008 are 270,000. Opening retained earnings are going to be adjusted here. Opening retained earnings plus profit of the year minus dividend, which we have already done, plus capital introduced during the year. So we have done the adjustment regarding opening retained earnings as well. Then we have 10% loan notes issued in 2000, $80,000. Now, students, the thing is that whether it's a liability, loan note is a liability, but it is a current liability or non-current liability, we have to see as per its date of repayment. So in adjustments, it must be written. Okay, it's a long-term loan because it is repayable 5 years. After 1 year, it has to be fulfilled, so it's a long-term liability. So non-current liability, 10% loan note. 10% is the rate of the interest. It is 80. Then we have purchases. Where does the purchases go? In statement of profit or loss? Here. Purchases are 470,000. Then we have sales. Where does sales go? Again, statement of profit or loss. These are 1,300. These are our sales. Then we have inventory, opening inventory. At 1st April 2008, it goes to the statement of profit or loss, opening inventory. It's 150. Now we have trade payables. Trade payables go where? Trade payables come in our statement of financial position under the head of current liabilities. Trade payables of 60. Then we have trade receivables. Trade receivables are our current assets. Trade receivables are 728. So we are done with the trial balance. Now we have to see our additional information. Is everyone clear up to here? Okay. Now, students, in additional information, the first one is inventory at 31st March 2009 was valued at $250,000. It's a closing inventory. Those things which are mentioned in the additional information will be having few adjustments. So this closing inventory has to go at 2 places. Closing inventory will be going to our statement of profit or loss. Closing inventory has to be deducted. Its amount is 250,000. On the other hand, this closing inventory has to go as the current asset in our SOFP also. Our current asset, students, less place is there. Okay, anyhow, it's current asset inventory. How much it is? 250,000. I hope that you are able to understand it. Okay, we are done with inventory, mark tick. Then we have second adjustment. Buildings and plant and machinery are depreciated on straight line basis, assuming no residual value at the following rates. We have 2 methods of depreciation. Depreciation can be calculated either using straight line method or using reducing balance method. If it's a straight line method, we can calculate it in 2 ways, either by using a formula or by using a percentage. When we have to calculate the depreciation by using a formula, the formula is cost minus residual value divided by estimated useful life of an asset. If the figures to be included in the formula are not given, then you have to calculate the depreciation using the percentage. In order to calculate the percentage basis method for straight line method, you have to apply the percentage of the depreciation on the cost of an asset. This percentage of depreciation will be applied on the cost of an asset. Ali, are you getting clear? Sorry? Cleared? If you are using reducing balance method, in reducing balance method, you have to calculate the depreciation by applying the percentage on the carrying value of an asset. On the carrying value of an asset. What is the carrying value of an asset? It is cost minus accumulated depreciation. Got it? So this is depreciation as per IAS 16. Now they are telling us in adjustment number 2 that buildings and plant and machinery are depreciated on straight line basis, assuming no residual value at the following rates. So on cost, we have to calculate the depreciation regarding buildings 5%, and for plant and machinery, it's 20%. Students, relevant to depreciation, point 4 is also written. Have a look at point 4 also. The depreciation charges for the year to 31st March 2009 are to be apportioned as follows. 60% of the depreciation has to be charged to the cost of sales, 20% to the distribution, and remaining 20% to the admin expenses. Sometimes in the exam also they are going to give you this condition. You are going to calculate the total depreciations. Out of the total depreciation, 60% you are going to charge to the cost of sales as direct cost, 20% and 20%. 40% will be charged to the distribution and administrative expenses. First, you have to calculate the depreciations. So it's very simple. Straight line method is going to be used, and for buildings it's 5%. For buildings it's 5% on cost. So depreciation on building, first we are going to calculate. It's 5% on cost. What is the cost of the building? Can anyone tell me? Cost of the building, as you can see in the trial balance, it's 100,000. Is it? 100,000 is the cost of the building. So how much it is? 5% of 100,000. Yes, students. You can calculate the depreciation on the plant and machinery also. For plant and machinery, it is 20% on the cost. The cost of the plant and machinery is how much? It is 125,000. Students, calculate the depreciations for building. How much it is? 5,000. And for plant and machinery? It's plant and machinery is just 125,000 multiplied by 20%. 25,000. So we have calculated the depreciation for both these items. The building depreciation together with the accumulated depreciation up to the last year, we have to deduct the current year depreciation as well. From the building, how much we are going to deduct in SOFP? 5,000. Is it? Is everyone getting it? The total accumulated depreciation up to the reporting date has to be deducted from the cost in SOFP. Okay? And in regards to the plant and machinery, it's 25,000. So from plant and machinery also, we are going to deduct it. This is the one adjustment in regards to the depreciation. Then this current year depreciation charge, this one and this one, has to go into the statement of profit or loss as well. Got it? Now, out of this 5,000 and 25,000, 30,000, 60% will be going to the cost of sales as per the point number 4. 20% to the distribution expenses and 20% to the admin expenses. So calculate it, 25 plus 5, 30. 60% of 30 is how much? Total depreciation is 30,000. 60% of 30,000 is how much?
78.
60% of 30,000. 18,000? 18,000. Okay, now 20% of 30,000? 6,000. And this one also 6,000. Now the 60% 18 will be charged to the cost of sales. In the direct cost, we can write 18. Then 20% has to be added to the admin expenses. How much it is? 6,000. And 20% has to be added to the distribution expenses, that is 6,000. Okay, now. Adjustment number 5. Income taxes for the year to 31st March 2009 are estimated to be 135,000. The income tax which is mentioned in the adjustments is which one? Is the current year tax liability. On one hand, this current year tax will be going to the current liability, 135,000. On the other hand, it will be written in your SOPL as well, 135,000. Done with that? Then point number 6. The 10% loan note was issued on 1st April 2007 and is repayable 5 years from that date. Every year on the loan note, we have how much interest? 10%. What was the amount of loan note? We wrote it there, loan note. This one, non-current liability. It's 80,000. 10% of 80,000 is how much? Total interest for every year of the loan note is how much? Total interest is 8,000. But interest paid during the year, we wrote it over there, finance cost, it's only 5. We have paid only $5,000 during the year. Paid amount is 5,000. It means that as per the accrual basis of accounting, remaining 3,000 is accrued interest. Accrued interest does go, accrued interest or accrued expense does go at 2 places. On one side, in the current liability. On the other side, in statement of profit or loss, it has to be added to the relevant expense. So 3,000 is our accrued interest. On one side, we are going to write it in the current liability, 3,000. And on the other side, we have to add it to the relevant expense in our SOPL. So we are done with the finance cost as well. Now on point number 7, the year-end provision for warranty claims has been estimated at 75,000. Warranty costs are charged to administrative expenses. I told you for one point to make a start for warranty expenses, warranty provisions. Opening warranty provision was 90,000 and closing warranty provision is 75,000. What are we going to do with that? Warranty provision is our liability, is it? Current liability, we can write warranty provision over here. The closing warranty provision is going to be written like any kind of the other provision. Closing warranty provision or any kind of the provision will be written in our current liabilities. How much it is? 75. Then there is a decrease in provision. Decrease in provision is going to decrease your expense. From the relevant expense, they are telling that we are charging them to administrative expenses. So that decrease in expense has to be deducted from our administrative expenses. How much decrease is there? Opening was 90,000 and closing is 75,000. By 15,000 is being reduced. So 2 treatments for warranty provision we have done also. Now students, you have to calculate the figures. You are going to calculate the profit after tax. The only adjustment in SOFP, what you have to do now is to add the figure of net profit over here. Okay. Please do the calculation and tell me the final figures. Tell me how much profit after tax is there. Students, are all of you getting clear? Tell me honestly. Honestly. Marva, are you clear, dear? Yes, Samiha, are you clear, dear?
Yes, ma'am.
Okay, great. Students, we can have a break. I forgot to tell you people that in between these 3 hours of the lecture, we do get half an hour break. Okay? So it's 4 o'clock right now. We can have a break for half an hour. At 4:30, we can resume our lecture. Sabrina, is this your first exam you are taking from CEC? Have you already studied? Okay, how many papers have you passed? Tomorrow you are going to give the third one? Which exam? F2. This one is the third exam for you. You have already passed F1 and F3. And what about F4?
I'm going to wait along with F7.
Along with F7. So I didn't see you in F4 class today. Sorry?
I'm going to wait.
Oh, great. Are you also the student of Hashim? Are you also the student of Hashim? Are you studying from Hashim? Okay, you don't know about Hashim. Hashim is one of my students who is giving coaching to so many other students. Okay. Okay, students, and see you after half an hour. Okay. Okay, my online students.
Okay, miss.
Yes, ma'am.
Yes, my online students. Are you there?
Yes.
Students, did you finish this question? Have you finished it? Did you calculate the net profit for the year? No? Do you want to calculate or shall we move on? Yes, you can calculate. It's okay. Please calculate. Tell me the total profit for the year. You must also analyze that in this particular question, we did not have any item to be written in other comprehensive income. Otherwise, we have to make one part for the other comprehensive income as well, and we have to mention all of the other comprehensive incomes over there. Yes, my online students, has any one of you finished this question? Did you try to complete your SOFP? Okay, you can complete this question from your homes. Now we have understanding number 1 in this chapter also. Marva, are you fine? Okay, understanding number 1. The requirement of this understanding number 1 is, students, it's page number 13. The requirement of this understanding is to prepare the statement of profit or loss and other comprehensive income, statement of changes in equity, and statement of financial position for the year ended 31st March 2007. May I please request you all to prepare the statement of profit or loss and statement of financial position. Please start preparing statement of profit or loss and statement of financial position. Statement of changes in equity, we are going to prepare it together. Do you want me to do this question or do you want to try it by yourselves? Yes, Shweta? You will try? Okay, great. Okay, Asif is also there. Asif, where are you, dear? Sorry, I did not take your name since I did not see you.
Yes, ma'am, I'm here. I'm here.
Okay, so are you finding the lecture helpful?
Yes, ma'am. Yeah,
Okay, try to attend the physical classes,
sure,
obviously,
ma'am, sure.
especially for the numerical subjects, okay?
Yes, ma'am, sure.
Yes, students, I want to discuss one more thing with you. It's regarding the timings of the class. We were thinking that if we can have our F4 class in the morning of Wednesday and F7 on Friday morning. Is it fine for you all? F4 from 10 o'clock to 1 o'clock and F7 Friday from 10 o'clock to 1 o'clock. Is it fine for all of you? No? No, Samri? Why?
She's an exam.
Having an exam?
I can't come.
You can't come on? Friday you can't come? Why? Is there any specific reason regarding that?
Actually, it's my mother only.
Okay. So can we do like that? We can have F7 on Thursday morning and F4 on Friday morning. Okay? Is that okay for all of you? Yes, for online students, you do tell.
Yes, miss. Okay, miss.
Great, great. So we are going to update the timetable. Now we are going to have our F7 class Thursday in the morning and F4 class Friday in the morning. Fine for everyone, is it? Fine?
Yes, miss.
Yes, Steve? 10 to 1. Yes, I told 10 to 1. Did I tell something different? Yes, yes, is it? Yes, Steve. Okay, we can have it at from 9:30 to 12:30 then. Okay, on Friday, whatever class we are going to have, we can start it around at 9:40. It will be started because obviously when I come to the college, I do need some time. Okay, because this class is very far. So in order to reach this class, I need at least 5 minutes. Okay, I will be reaching around 9:35 to the class, and we can extend the lecture accordingly. Okay. Okay, understood. Yes.
Wednesday, Thursday, or Thursday and Friday?
What about Thursday and Friday?
No, is it Wednesday and Thursday or Thursday and Friday?
Thursday and Friday both. Are you going to take a 4 class as well?
I mean, if you want to join. So,
If I thought that you are going to take the class, then take it. You will come and 4 instance. Okay, so F4 will be on Friday and F7 will be on Thursday from 10 o'clock to 1. But for on the Friday, we are going to change the timings. It will be from 9:30 to 12. I will be sending you the updated timetable. To all of you, I will be sending you. If you want to ask anything, you can ask. Yes, dear. Okay, students, let's start doing it together now. Okay. We are required to prepare 3 important financial statements: statement of profit or loss and other comprehensive income, SOFP, statement of financial position, and statement of changes in equity. So first, let's have a look at the preparation of statement of profit or loss. As they have given us the trial balance, you can see the following trial balance has been extracted from the books of Aaron as at 31st March 2007. The reporting period is ending at 31st March 2007. If it's ending at 31st March 2007, it was starting at 1st April 2006. 1 day and 1 month after and 1 year earlier. So it has been starting on 1st April 2006. The following trial balance has been extracted from the books of Aaron as of 31st March 2007. First, we have administrative expenses. As from the format, we can see that these administrative expenses have to be written in statement of profit or loss. So we can write them over here. It is 250,000. Then we have distribution costs, 295. Just below to admin expenses, we can write distribution expenses also, 295. We are done with both of these. Please take them. Then we have share capital at $1 each. Share capital does have its place in statement of financial position, and it goes in the statement of changes in equity too. Okay, so we are going to look at the statement of the changes in equity later. First, have a look at the equity. The share capital of how much? 270. Students, together with that, we can make the statement of changes in equity here. Okay, so we can just compare all of these statements as well. So over here, we are preparing statement of changes in equity. On the top, we are going to give the heading, Aaron, statement of changes in equity for the year ended 31st March 2007. We are going to give the few headings as share capital, is it? Then we have share premium. If there is any kind of revaluation surplus, we have to make the column for that as well. And one important column is retained earnings. We do the total horizontally, and vertically also we are going to make the total. We do start our statement of changes in equity with the opening balances. Opening balances as at 1st April 2006. Opening balances at 1st April 2006, we have to write in the start of the changes in equity. Anyhow, share capital 270,000. It's an opening capital. So share capital opening balance is 270. So we have written it here and here as well. If we are making a statement of changes in equity, it's better to first extract the balances from the statement of changes in equity, and the closing balances you write under the portion of equity in SOF. Okay. Then we have share premium of 80. We are going to write the opening balance of the share premium also. It's 80. Then we have revaluation surplus. Revaluation surplus of 20 is there. Dividends paid. Dividend paid is going to be deducted from the retained earnings. Is it? Dividends paid. How much dividend is there? 27,000. So we are going to deduct it from this column of retained earnings. Then we have cash at bank and cash in hand. Cash at bank and cash in hand is the current asset. It goes to your current assets in your SOFP. We can write cash in hand over here. How much it is? It is 3,000. Then we have receivables. Again, receivables are our current assets. How much are these? 233. Then we have interest paid. Interest paid is our finance cost. It goes in our SOPL. Interest paid is how much? 25,000. Then we have dividends received. If they are dividends received, it's an other income, and you have to write it in your SOPL. Dividends paid go to statement of changes in equity. Dividends received come in your SOPL as your other income. So your other income has been here. The dividends received are 15, and we have other income just below the dividends received, interest received as well. So 15 plus 1, both we are going to write in our other income. Then we have land and buildings at cost. Out of this total of 480,000, land is 380,000 and building is 100,000. We are going to write them in our non-current assets. Land is 380,000 and buildings are 100,000. Accumulated depreciation is also written. For land and buildings, it's 30,000. So from buildings, we can deduct this accumulated depreciation. Then we have plant and machinery at cost. Plant and machinery also goes under non-current assets. Plant and machinery. Cost is how much? It's 400,000. And its accumulated depreciation is 170,000. Students, I am performing the questions little bit quicker as I assume that you are having a pre-built knowledge about this. If you are not understanding any point, please do not hesitate to ask me. I will elaborate the points if you are not understanding. So plant and machinery cost minus opening accumulated depreciation we have deducted. The depreciation charge for the current year will be deducted from here as well. We are going to write it in our SOPL also. Okay, then we have retained earnings accounted 1st April 2006. Opening retained earnings of 235. We are going to write in statement of changes in equity, 235,000. Then we have purchases. Purchases does have their place in our SOPL. Purchases, how much purchases are there? 1,260,000. Then we have sales. Sales of 2165 are there. Sales 2165. Then we have inventory at 1st April 2006. Inventory which is written in trial balance is always an opening inventory, whether they are mentioning the date or not. It's an opening inventory. The inventory which is present in additional information is the closing inventory. So inventory, opening inventory at 1st April 2006 is 140. Opening inventory we are going to write under cost of sales 140. Then we have trade payables. Trade payables are our current liabilities. They go under the in our SOFP. Current liabilities, trade payables of 27,000. Then we have bank loan 100,000, but whether it is a long-term liability or the short-term, we have to see. For loan, they say in the 5th point, the bank loan is repayable in 5 years' time. So it is again a non-current liability, bank loan. It will be written under the non-current liability. Loan is 100,000. We are done with the trial balance. Now we are going to move to the additional information. Additional information number 1. Inventory at 31st March 2007. It's a year ending date. Inventory at 31st March 2007 was valued at the cost of 95,000. Our closing inventory at the year ending date is $95,000. Included in this balance were goods that had cost $15,000. These goods have become damaged during the year, and it is considered that the goods could be sold for $5,000 after paying commission of $500. Over here, they are using IS2. IS2 inventories. IS2 inventories says that inventory has to be valued. Inventory has to be valued and will be written in our SOPL and our SOFP at the cost at a price lower than cost and NRV. We are going to record our inventory at a price which is lower of cost and NRV. We are going to compare the cost of the inventory with its NRV, and whichever is lower, at that amount our inventory is going to be recorded in our financial statements. What is the cost? Purchase price plus all the directly attributable costs, which can include all the direct costs simply. On the other hand, what is NRV? NRV is net realizable value, which is estimated selling price minus estimated costs to sell. What is NRV? Estimated selling price minus estimated costs to sell. Whenever inventory is being devalued and it is not being able to be sold at its cost or at a price higher than the cost, then obviously we are going to realize only the net realizable value. Sometimes the inventory becomes obsolete and we are not able to sell it at the price which is favorable for us. So we are selling that amount of inventory at a lesser price. So the price which is lesser than the cost is obviously an estimated selling price minus all the costs which are necessary to make the sale. Those can be commissions, those can be any kinds of the repairs regarding inventory. So before to selling an inventory, if we have to make an additional cost, that cost also have to be deducted from the estimated selling price. So in the exam, if they do say that the cost of an inventory is, say for example, 10,000, whereas the NRV, net realizable value, is 5,000. So the value at which you are going to recognize the closing inventory is now 5,000. Because as for IS2, you have to recognize the inventory at the lower of cost and NRV, whichever is lower. If they are giving you the figures separately, then you have to calculate your own NRV and your own cost in order to compare both of these. Very often, they are going to give you the figures separately. They will be giving you the estimated selling price and they will be giving you the estimated cost to sell, and you have to calculate your own NRV. Like in this question, they are telling inventory at 31st March 2007 was valued at the cost of 95,000. Included in this balance, there were goods that had cost 15,000. There were goods which have been costing us as 15,000. Is this what they are telling? They also say these goods have become damaged during the year and it is considered that the goods could be sold for 5,000 only. Now, the estimated selling price is 5,000. But after paying the commission of 500, estimated cost to sell is 500. So it means that your NRV is how much? 4,500. Got it? So now at which price your inventory has to be recognized? At this 4,500. 4,500 is the amount for the inventory which is costing 15,000. Out of 95,000, for 15,000 inventory, we are going to recognize it for 4,500 and remaining 80,000 obviously is going to be recognized. Total closing inventory has been how much? It's 95,000. Is it? We are doing this calculation for the inventory of the 15,000 cost. This 15,000 inventory will be now recognized at 4,500 and remaining 80,000 will also be recognized. So the total amount of closing inventory will now be 4,500 plus 80,000. It will be 84,500. Got it? Here at this point in your book solution, there is a mistake. When they are calculating the net realizable value, they have skipped this amount. They have not deducted the commission. Okay. Anyhow, if we are deducting this commission or not deducting the commission, our balance sheet is still going to match because closing inventory is coming at one place on the SOPL and on the other place at SOFP as well. Our balance sheet is still going to match, but you should be clear about the concept. Okay. So estimated cost to sell minus estimated selling price minus estimated cost to sell is your NRV. And you are going to compare your NRV with your cost, whichever is lesser. At that amount, you are going to recognize your closing inventory. So now your closing inventory is 84,500, 84.5. Is it? 84.5 is going to be deducted from here. And in our current assets also, we are going to write inventory at 84.5. Okay, then students, second point. This point usually comes in the exam for checking IS2. Okay. Question point number 2, depreciation for the year to 31st March 2007 is to be charged against cost of sales as follows. So we are going to charge depreciation in our cost of sales. So on buildings, it's 5% on cost, straight line and plant and machinery is 30% on carrying value, reducing balance method. So for buildings, it's 5% on cost. How much our buildings have been? Buildings cost is 100,000. On 100,000, we have to calculate 5% of depreciation. Depreciation on buildings. It's straight line method and it's 5% on the cost. And cost of the building is how much? 100,000. So 5% of 100? Sorry? 5 we are going to take, okay? So 5 we have taken, and then for next, for plant and machinery, it's 30% on carrying value. Reducing balance method is to be used for plant and machinery. Regarding reducing balance method, what did I tell you? That the percentage is going to be applied on the carrying value of an asset. And what is a carrying value? Cost minus accumulated depreciation. So the percentage of the depreciation is how much? It's 30%. It's 30% depreciation. It has to be applied on the carrying value of plant and machinery. Plant and machinery carrying value is how much? Cost minus accumulated depreciation. Cost is 400 minus accumulated depreciation is 170. So this will be your depreciation on your plant and machinery. How much it is? Calculate. 69. So these two depreciations we have, all of these are going to be charged in SOPL in cost of sales. Okay, 69 plus 5, 74. 74,000 depreciation will be added to our cost of sales. Together with that, the depreciation, current year depreciation has also to be deducted from our relevant assets in SOFP. So the depreciation on the building has been how much? It's 5,000. Depreciation on the plant and machinery is how much? 69. Okay, then students, next point. Land is to be revalued upwards by 100,000. Land is being revalued. A revaluation has to be regarded in two places. First, that it has to be added in the value of the land in your SOFP. Before, land has been 380,000. Now 100 revaluation is being done. Okay, so 100 is going to be added. 380 plus 100. On the other hand, since it is unrealized gain, that is why we have to write it in our other comprehensive income. Now we have to make the separate part for the other comprehensive income also, and we can write yes, gain on revaluation. Gain on revaluation is how much? 100,000. Okay. Okay. And revaluation has to be added in statement of changes in equity as well, since it is our reserve. Current year revaluation 100. Clear, everyone? Okay, now the next point. Income tax of 165,000 is to be provided for the year to 31st March 2007. It's a current year estimated tax. It will be going to the current liability tax of 165,000. Moreover, it will be going to our SOPL as well, 165. The last thing, the bank loan is repayable in 5 years' time. So we have already regarded that, and we have written the non-current liability, or we have written the loan under non-current liability. We are not going to take any kind of interest, since it is not mentioned how much interest percentage is there on the loan. Okay, so we are not going to regard that. Now you have to calculate the closing balances. Closing balances in statement of changes in equity. Calculate the totals vertically also. 270, 80, 120, 235 minus 27. 200 and how much? 202? 208? Okay, 208. So now these closing balances have to be written under the head of equity in our SOFP. How much are these? Share capital is 270. Then we have share premium of 80. Then we have revaluation surplus, it's 120. And then we have retained earnings of 208. One mistake we have done. We have to add profit for the year over here. Profit we have skipped. We cannot skip profit. Profit has to be added over here in retained earnings, and this closing retained earning that will be going over here. Okay, so start over here. Current year profit, which you are going to calculate from your statement of profit or loss, has to be added in your retained earnings over here, and then the closing balance of the retained earnings will be going under the head of equity. Okay. Now you can calculate your figures too, if you want to calculate. But see if you are clear about the things or not. Up till now, whatever we have discussed is just a revision of your F3. Quickly, we have revised so many concepts of your F3 subject. Okay, and it was necessary because without this revision, we cannot move on. So this is, there is not any kind of new thing what we have studied in this lecture, but it's kind of a revision. No, tomorrow there will not be any class. From next week, you have to follow the time. Okay. Okay, Samreen, tomorrow at which time are you going to come to give exam? 10 o'clock in the morning. Who has given you this time? Sorry, Mr. Helgen? Okay. Okay. Yes, dear. 100, which one? This 100 in calculation, revaluation surplus. It's written in the adjustment, if you can see, adjustment number 3. Land is to be revalued upwards by 100,000. Okay, so this is the current year revaluation. Marva, do you want me to take the picture of this? Sure. Okay, students, I will be sending it in the group then. Although my writing is awful, but I hope, but in the book also you can get the solution. No, Marva, I don't want to send it in the group. Okay. I can send it to you individually. Okay, dear friend. Yes, are you interested? Yes, dear. Sorry? What do you want to have?
Check.
Speak loudly.
Can you add me to the group too?
Yes, sure, I can add you to the group as well. Sure. Please give me your number.
050.
Wait. Zero 50 452 5279. Ali, from where do you belong? What is your nationality?
My dad is from here and my mom's from So some from here.
That's why your accent is different. I was thinking like this. Is his accent different?
What do you mean here?
Little bit difference is there. Arabic accent. It is. Do you speak Arabic? That's why.
Miss can also add me. Can also add.
For sure. Why not? Yes, Samreen, please tell me your number. 050 36 45. Wait. 3645 246. 050 3645 246. Okay. Yes, students, are you added? Yes. Sharifa, I have added you already. No? Okay, let me add you. But I have your number. No, I saved your number, I still remember, but you were not on WhatsApp for that number. I will tell you which number is saved by me. It's 052 555 1607. Oh, that is okay, dear. Let me just delete that number first. Yes, Shri. Now tell me.
050
050
923
923 24
86.
86. 050 923 2486. Now, are all of you added in the group? My online students, you do, Ali, are you added? Okay.
No, miss.
Okay, now students, okay, great. Now students, we are briefly going to discuss our next chapter, that is IAS 16. Tangible non-current assets. Just a brief discussion we are going to do regarding that, and then we are going to finish our lecture for today. The importance of this chapter is that none of the paper of reporting is completed without this chapter, without this topic of tangible non-current assets. The international accounting standard which deals with the tangible non-current assets is IAS 16. And we are already familiar about this standard. Whatever we have discussed about tangible non-current assets in our F3, the similar type of the discussion you are going to face over here. But in your F3 book, there have been 2 chapters on IAS 16. In this chapter, they are briefly and summarizingly discussing all of the discussion regarding tangible non-current assets. You must be knowing that the assets can be classified into 2 broad categories. When we do speak about assets, assets are all those economic resources which are used by the business in order to generate income. Whatever is being used by the business to generate income is an asset. Say, for example, in KUKA, these chairs, these seats are being purchased so that the students are going to sit on these. They will be coming to the campus, they will be taking the classes, and generation of revenue is going to be there. So these are assets. This computer, it's an asset. This building, it's an asset. This AC, it's an asset. All those things which are helping the business to generate revenue are assets. Under assets, we have 2 broad classifications: non-current assets and current assets. Those assets which will be helping the business to generate revenue for the period of more than 1 year are known as non-current assets. They are going to help generating the revenue for the period of more than 12 months or 1 year. Those assets which will be helping the business to generate revenue for the period of lesser than 1 year are current assets. So, less than 12 months, less than 1 year. Under non-current assets, then we have 2 broad categories: tangible non-current assets and intangible non-current assets. Those assets which are having a physical substance which can be seen and touched are known as tangible non-current assets. Say, for example, furniture and fixtures, motor vehicles, land and buildings. These are tangible non-current assets. The International Accounting Standard which deals with tangible non-current assets is IAS 16. The second category of non-current assets is intangible non-current assets. All those assets which do not have any physical substance but still helping the business to generate revenue are intangible non-current assets. Say, for example, goodwill. Goodwill, the purchased goodwill. Inbuilt goodwill is not going to be recognized. Purchased goodwill with the purchasing of the business which is already running. So the goodwill does come under IAS 38 intangible assets. It is going to be an intangible. Then franchises, then patents, copyrights. All these rights are basically our intangible assets. We are not able to see them. We are not able to touch them, but still they are helping the business to generate revenue. So the standard which deals with intangible assets is IAS 38. We have separate chapter for IAS 38, but in this chapter we are discussing IAS 16, and 2 more standards are discussed in this chapter which are relevant to the tangible assets. That is regarding borrowing cost, IAS 23. So we are starting with the IAS 16. Then in this chapter we are going to discuss about IAS 23 borrowing costs as well. Why are they combining 3 standards in this one chapter? Because they are relevant to each other. Okay. Now, as you do know that in this chapter, we are primarily going to learn about the tangible non-current assets. You must also be knowing that what does come under IAS 16. IAS 16 tells us about the recognition of the tangible non-current assets, mainly property, plant, and equipment. Recognition. It tells us about the measurement of the tangible non-current assets. And the third thing about which the standard tells us is de-recognition of the tangible non-current assets from the books of accounts. Under IAS 16, we are going to learn about 3 things: recognition, measurement, and de-recognition. As you can see, they are giving us an overview what we are going to learn in this chapter. Tangible non-current assets, How are we going to measure these? Does come under IAS 16. One of the tangible non-current assets is investment property, but IAS 40 covers it, and it is not discussed in this chapter. Okay, separate chapter. Depreciation comes under the measurement. IAS 16 deals with that. Revaluation, how are we going to revalue the non-current assets when their value is becoming upward, when their market value is becoming more? It also comes under IAS 16. So these things we are going to discuss in this chapter. Then borrowing cost. If we are borrowing an amount to finance our property, plant and equipment, it is related to the IAS 16, but it is going to be calculated under IAS 23. Then government grants. Sometimes the government wants to promote certain type of the businesses. That is why they do give them grants to purchase machinery, plant or equipment. If we are taking the government grant in order to finance our plant and machinery, our tangible non-current asset, what are we going to do with that? We are going to learn in government grants IAS 20. So 3 standards, primarily we are going to discuss in this chapter IAS 20, IAS 23 and IAS 16. And this we are going to discuss in our next lecture. Students, in our next lecture, we will try to finish the discussion regarding IAS 20, IAS 16, IAS 23 together with IAS 38 as well. I will try to finish all these standards. So if you do get a time, please do read them from your homes. Okay. So when you will be coming to the college, you will be able to discuss the things with me as well. Okay. So now this is all for today, my online students and my offline students. Now you tell me, are you enjoying the lecture? Now today you are looking a little bit tired also, especially Ali, because he is here, and Aisha and Rabia too. They are here from 10 o'clock. So maybe you people are more tired. So it's good actually, because we have changed the timetable now. Actually, I had designed the timetable for the convenience of those students who are taking F4 and F7 both. So I was thinking that at the same day you will be able to attend both the classes and you will not be coming to the campus for 2 days. So I thought in that way. But now it's much more better. So for your know-how, we have designed the timetable now as on Thursday, we are going to have F7 in the morning from 10 o'clock to 1 o'clock. And on Friday, we are going to have F4 from 9:30 to 12. Okay. So now we are going to update the timetable in this manner. Samreen, is it okay for you now? Okay. Yeah. Yes, my online students, any questions, any queries?
No, miss.
Okay, great. Okay, students, and see you in the next week. I will be ending the meeting now.
Thank you, ma'am.
Thank you, miss.
Take care. Goodbye.